Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. Before we get into today's video, I just want to have a quick moment of silence for the All Blacks. Alright, now that that's out of the way, today I want to make a quick sort of response video actually to a video that Jeremy over at the Financial Education channel just did yesterday around why he's always typically somewhere between 10% and 30% of his investment accounts in cash. So for me personally, if you've watched some of my older videos, you may have heard me mention that I was like 50-60% cash earlier this year, and that's actually changed to also almost no cash at this point, so less than 10% if we don't include emergency funds and day-to-day kind of money and that sort of thing. If we're just talking about investment accounts, I'm less than about 10% cash right now, and the reasons for that, there's really two main ones that I want to get into. One of them is hopefully applicable to a few of you that are really working away at trying to find good investments, and the other one is often going to be quite applicable to newer investors and particularly younger investors who are have still got relatively small amounts of money to invest in the grand scheme of things. So I want to run you through the reasons why I am in the situation I'm in now and why I've chosen to do that, and this may or may not apply to you as well. So I hope you enjoy the video, but for now, let's get into it. Okay, so before we dive into why I specifically have a relatively small amount of cash in my investment accounts at the moment, I first want to dive into a couple of reasons why cash, generally speaking, is a terrible investment and something that you should be basically doing your best to get rid of. Essentially, I want to use Jeremy's example as a way to kind of run some numbers on how this exactly might look. And really, it's diving into a concept called cash drag. So cash drag is simply when you have a percentage of your money sitting on the sidelines and not invested, and it is pulling down the overall return of your portfolio. So if we take Jeremy's example, he always has somewhere between 10 and 30% of the portfolio in cash, so let's call it 20% on average. And let's go ahead and run some basically compound interest calculators and see the effects of having that cash sitting there and not invested, and how that can potentially pull down your returns. So I'm going to put some screenshots that I'm just working away on my phone here at the moment. But if we have $10,000 as a starting point for your investment account, we run this compound interest calculator over a 40-year period, making a 10% return and adding $5,000 every single year. Then after 40 years, we end up with $2.6 million, which is great. And I'll just take a quick screenshot of that. We end up with $2.6 million, and that's assuming a 10% return. Let's say the stock market capital gain plus dividends does 10% a year, and we're fully invested the whole time. That is basically how that would look. So that's situation A. Situation B is what essentially Jeremy's doing. When he has 20% of his portfolio sitting on the sidelines, he's essentially sacrificing 20% of that gain. So rather than doing a 10% annual rate of return, he's actually going to be dropping that down to an 8% return. So if we again run the same numbers with only an 8% return rather than 10%, we get a pretty dramatic reduction in the overall amount of money that we've got at the end. So we drop from 2.6 million down to 1.5 million. So it's cost us almost $1 million in this case to have about 20% of the portfolio sitting on the sidelines. So that's just a quick run through of what cash drag is and some of the reasons why you should be trying to at least aim to be nearly fully invested the whole time. In practice, if you're picking individual stocks and you're struggling to find good deals, that can be a hard thing to do without paying ridiculous prices. And there's also advantages to having cash sitting on the sidelines that we really haven't gotten into. So guys like Phil Town, Warren Buffett, even in the last recession, and people that really know how to value businesses can often take advantage of having cash on the sidelines. So if there is a quick drop in the stock market, they can actually use that cash to invest at ridiculously low prices and actually increase their rate of return. So that's certainly a consideration, and that's a reason why I did have a reasonable amount of cash on the sidelines at the start of this year. But I want to dive into the reasons why that has changed for me personally. But first, I thought it was important to run through why we want to at least aim to be largely fully invested as much as we can. It's difficult when prices are high and we're really searching for bargains and that sort of thing. But let's get into it. So fundamentally, there are two reasons why my cash position has come down and why I've let it come down as dramatically as I have done. So the first one is simply I've found investment opportunities. So recently, over the last probably 3 or 4 months, or 3 months probably, I've been buying into 2 new stocks. So I've identified 2 basically what I believe to be 50 cent or less priced dollars, so businesses that I think are worth $1 and they're selling for 40 or 50% of that. So I've gone ahead and made investments in those companies, and that's really the big reason why that cash position has come down. I've simply been buying stocks. I've simply been picking up some of these deals. And although when you look at the broader market, you look at the indices, the S&P 500, the Dow Jones, the New Zealand Top 50, all those things, prices have generally been going up this year. There are some sectors and some situations where prices have actually been going down, and I'm generally speaking not an investor in the overall haystack, the overall kind of market. I'm looking for individual companies, so it's very much opportunistic. When these opportunities do come up, I take them. I don't particularly care about what the S&P 500 is doing because that's so heavily driven by Apple and Amazon and a relatively small number of companies for the most part. I'm focusing on individual businesses, and I am picking up those opportunities, grabbing them and running when they do come up. So that's really reason number one. The example that often comes up at the moment around holding a lot of cash is Warren Buffett, and it's actually an example I've used earlier in the year around why I had a lot of cash at that point. Basically, Warren Buffett has something like $150 billion in cash and short-term investments at the moment, which are basically just placeholders for cash as well. And that's really because he is in the exact opposite situation to me. He can't find a lot of investment opportunities, and that's really because his universe is a lot smaller now. So if he wants to get a reasonable portion of that money into a business or into a stock, his universe is small. He doesn't have all that many opportunities to get into, and the chances that one of the 30 or 50 biggest companies in the world is going to be dramatically mispriced and he's going to get a real bargain is relatively small. So when you're a small investor working with small amounts of money, basically the world's your oyster. There's, I think, something like 5,000 stocks on the planet if you include all the different stock markets around the world. So there's a lot more opportunity to find these bargains as a small investor. But just thought I'd quickly touch on that one. That's really the first reason why. Let's dive into the second one, and this is the one that's going to apply to a lot of newer investors, I think. So stick around for reason number 2. Alright, so reason number 2 is, at the moment, my portfolio is, in the grand scheme of things, a relatively small amount of money. So I'm going to link a video probably up that corner. If it's not that corner, it's the other one, because I always get these the wrong way around. But I'm going to link up one of these corners that takes you to more of a personal finance video that I did a few months ago around how I save a very high proportion of my income and how I'm able to funnel that into investing accounts and various other things. And that's really the second reason why I do have a relatively small amount of cash in my investing accounts at the moment. So my portfolio is relatively small. I've been investing about 3 years now, but when I first started, it was very small amounts of money, and I'm trying to save and funnel money towards those accounts more aggressively over the last year or two. But essentially, the facts are that if I were to go all the way to basically 0% cash now and just invest everything, I would be able to save enough money to get back to about 40% cash in probably a year's time. So that is not something that you're going to be able to do if you're a billionaire, or if you're investing, if you're a hedge fund manager or something, and you're investing other people's money and they're not constantly contributing new cash to you. That's a situation that's relatively unique to newer investors, and it allows newer investors to be a bit more aggressive in terms of getting money into the market and getting it exposed to individual companies or ETFs or whatever approach you might want to take. So that's really number two. So in the grand scheme of things, if I was managing a few $1 million and I was 30 or 40 years into my investing journey, and the amount of money that I was saving from other endeavors in my life was relatively minor compared to this overall pie, I probably wouldn't, I definitely wouldn't have this lower level of cash. But right now, I'm pretty comfortable with doing that. There's going to be, I guess, some short-term risk for me if the stock market does crash in the next, 2, 3, 4 months. I might be stranded with only 10 or 15% cash in my accounts or something like that, which even then is still not the end of the world. I'm going to have still a reasonable amount of cash to funnel in, and the chances that the stock market is only going to stay low for a couple of weeks or a month or something is relatively low as well. So if we do have some sort of event that drives stock prices down overall, I'm still going to be able to have a reasonable amount of cash pretty quickly in the grand scheme of things. So that's really reason number two, and I think that's probably going to apply to a lot of the younger investors out there. Maybe you've just got out of university or something like that. I'm about 3 years into the workforce roughly, and like you saw in that video, if you haven't already seen it, go check it out. I'm able to save a pretty high percentage of my salary essentially. My earning power is going to go up over time in my job, and I'm doing my best to keep my expenses at basically a constant level. One of the great things university teaches us is how to live on not very much, so I'm trying to bring that university student lifestyle over to my current lifestyle as well, and live relatively cheaply. So basically any time that I have an increase in earning power or anything like that, that just goes straight to the bottom line for my personal accounts and extra savings. So that's the situation I'm in at the moment. I hope you enjoyed today's video and got a good kind of perspective on why I'm a bit more comfortable being in a smaller percentage of cash at the moment. So I hope you enjoyed that. If you did, hit like, hit subscribe, and that way you can see future videos as well. You can watch some older videos over there, hit subscribe over there, and then I will see you in the next one. Cheers.